digital asset financing is exactly what we do at Untapped. So definitely want to hear more about that and learn from you.
Awesome. Yeah.
Glad you can join us. Okay, we're going to start in just a couple of minutes. See if Looney has joined us and Geeta has joined us as well. Glad both of you guys are here.
Hi, Jim. Good to be here.
Hi, Looney. Welcome. Still on mute. So yeah, Geeta, I'd love to hear a little bit about your background. Well, I know your background, but I think everybody else would love to hear your background as well.
Thanks, Jim. So just a little bit about me personally. Botswana is home for me. Not much VC activity or PE activity happening there. I spent about the last 15 years of my career in private equity, investing in Africa, Latin America, and Asia. Over the last year and a half, I've gotten a lot more involved in the angel side of things, primarily in Africa.
Gotcha. Great. Well, welcome to the topic. And Looney, I think you just joined us as well. Love to hear a little bit about your background as well.
I did. Hey, everybody. So I'm a serial entrepreneur, have been for almost 30 years. And the last 9, I've started an impact-oriented accelerator, turned into a global network. It's called Fledge. And we wound up, not by original plan, but happenstance, most of our investments are over in Africa. We've helped and invested in 105 companies. Like 42 of them are African.
Excellent. Glad you could join us. Well, we've hit the hour, so let's get started. Over to the topic. So the topic for today is venture capital the right investment model for Africa? As you know, the success of technology startups, especially from the US, has become almost legendary. And so it's not a surprise that whether it's through muscle memory or through deliberate choice, we've copied and pasted the model for investing to other areas. Impact investing, investing in Africa, et cetera, et cetera. I think the question is, does it work? Does it work well? Is it right for investors? Is anyone making any money? Is it right for African entrepreneurs? Is it right for the continent? Is it what that continent need for economic development? And most importantly, what are the alternatives to the standard 2%, 20% carry equity investing model? So I think we have a great group of folks here. And again, as I mentioned earlier, we really invite others in the audience to participate in this discussion. And that's both here on Clubhouse. So raise your hand if you want to be on stage and have something important to say and to hear your feedback. But also on LinkedIn and on YouTube, we're streaming this live on YouTube, and you can comment via the LinkedIn page for this event by searching for the Nest Investment Network on LinkedIn. And we will do our best to pull out relevant comments and read them out loud here. So now that we've gone through the intros, I'd love to hear from some of your comments and feedback on the question. Is VC the right model for Africa?
I don't think you've defined it well enough, Jim. Do you mean,
okay.
So you said 2 and 20, but do you mean preferred equity, wait for exit, search for unicorns, all everything else that comes with the historic VC model, or VC as just in investing in young companies?
So I think what I would argue is that given the way that most funds are structured, and this is a broad generalization because not every fund is structured the same way, using a 2% management fee, 20% model, and using that to fund operations and so on, that tilts the incentives towards let's look for the unicorns, let's look for the blockbusters, let's go for an IPO. That's not necessarily the case for every VC investor, but that is generally what the fund economics pushes fund managers to do. So I think in my mind, and I think the genesis of this discussion really was around that, that tends to bias investment towards asset-light, high multiple companies. And that's a tiny slice of the market. There's a much broader market out there of, let's say, SMEs or companies that don't necessarily have the opportunity to go IPO or have a big exit, but are solid, highly impactful, very profitable companies. How do they get financing? So I think that's the starting point of at least my thinking. But I think your question is right on, spot on, which is what exactly is the VC model and how is it being applied?
I'll give a quick perspective from a fund manager's point of view. We find out that the cost of operating a fund in the African region, and barring a few countries which have good penetration of internet, mobile phones, and the consumers are using startup products, I think other than those particular countries, the cost of operating a fund in the region and actually the length of time it takes to find investments, evaluate them, and actually execute them, it's a big concern for us. And fund managers in the region are particularly called upon to take roles that are not typical of conventional fund management, because you need to get heavily involved in the investee's business because the whole ecosystem is a little bit nascent. So I think these are my initial thoughts, and these are my thoughts of working in North Africa. It might be different in different countries, but this is the premise that I want to enter this conversation with.
Well, certainly, having a small fund or not having enough capital or principal in your fund is challenging. It is very challenging given that model. Love to hear from Geeta. I know you've been operating in Africa for quite a while. What are your thoughts on this?
So I think the genesis of this this thread that you're pulling, Jim, which is it's a really interesting thread, goes back a couple of decades here, right? We've known there's always been financing challenges on the continent to finance businesses. It's particularly acute with early stage businesses. It's particularly acute with small and medium-sized businesses. And the bulk of businesses on the continent, which are considered investable, tend to be ones that the private equity firms go after.
Right.
And even with that, there are 16 stock exchanges or so on the continent. Very few firms are expecting the exit route is going to be via listing. So you're left with dealing with what I call the realities of these businesses. And for that, where I see VC coming in is it's another bow in the quiver. It's another quiver in the bow. I think that's the right way to say it.
Right.
I think it's adding to the types of financing that can be made available, that are made available. But Jim, you know me as being very focused on fundamental investing. And the bigger question for me is bringing capital in, whether it's through the VC route, whether it's through the private equity route, whether through its crowdfunding. We had a discussion on crowdfunding quite recently. The deeper question for me is, can the businesses who are getting the capital bear the burden of that capital? And
Right.
The thing that worries me when we talk about, is it the right investment model for Africa? It is, in my view, right if it is coming in with the intention to be linked to real value that is being created. Real products and real services which are being consumed by real people. Otherwise, it feels very much like sometimes there's a fair amount of rent-seeking behavior that happens. And we've seen a lot of this in Silicon Valley, right? Where the valuation of businesses is completely divorced from the cash flow and profitability of these businesses over a longer period in time. In which case it feels genuinely like a game of musical chairs, and you just want to make sure that you're not the last one left standing when the music stops.
Right.
The value of these businesses, early stage businesses, to me, starts with what are they doing for the economies? What are the real services, the real goods that they're providing? And is there a market for them? As opposed to, is there a sufficiently sexy story to tell around it, which is going to generate interest in the next round and the next round, which drives up valuations?
And going back to Looney, I think your comment earlier, I mean, I think that's one of the things that I see in the US market, whatever opinion we have about this game of musical chairs. I like that analogy, by the way, Geeta. There is ultimately an IPO market, and you could be very cynical and say, yes, there's always that IPO sucker. You can sell it to retail investors, but you don't have as much of that in Africa. And so to
Well,
your point, Ita, right? You need to really create value and solve a real problem,
I
not
want
just
to.
have a lot of scale. Go ahead, Looney. Sorry.
Yeah, Jim. I got back in the day, back when we had in-person meetings. The U.S. State Department brings in delegations from all around the world for entrepreneurship, including entrepreneurs and groups that train entrepreneurs. I don't know exactly why they do this, but they do this. And somehow I got on the list where they come and they visit Seattle, and I get to speak to them. And inevitably, they all say, how do we get an ecosystem that works like the US? And my opening line, because everybody asked this. And so my response to that is, you've been misinformed. You have the wrong assumption. The US as a whole, no more entrepreneurial than your home country. What you're seeing is San Francisco, New York, Boston, Seattle, LA, Boulder, Austin. Sorry, I didn't forget Austin. Those cities have a thriving venture capital startup community, and the rest of the cities in the U.S. are absolutely no better than your capital, right? So when you say VC, it only works in 6 or 7 or 8 cities in the U.S. So if you're from Chicago, I don't know who on this call is from Chicago, you guys don't have a functional VC economy, nor Houston, nor Dallas, nor Atlanta. Like, there's huge cities in this country where it doesn't work. It only works in a few cities. And so when we say, can it work in Africa? No, it can't work in Africa. It doesn't work in Chicago.
Right. So I think what we see is, whether it's subconscious or unintended, a lot of people striving towards building that same ecosystem, whether that's in Lagos, Cape Town, Nairobi,
and it makes
cetera,
the
right?
news here, right?
It does.
It
It's
makes the newspaper, makes the news, it makes the news, the
Right.
blogs now, and it's sexy, and so people just copy it without thinking about, well, does it work even as an industry? We know it only works for like 15% of the VCs.
So we're 10 minutes in, and we're in violent agreement around, well, look, this model might not be the perfect model. I think maybe to be the most constructive and productive, what are some alternatives?
Can I just point out,
Yes.
even though we're saying that we're looking for, as outsiders and advocating, can the VC model work in Africa? We're forgetting there's one very successful private equity VC group out of Africa that has made phenomenal returns. It was a media company that turned to be a internet technology giant called Naspers.
Naspers, yeah.
And they've gone around the Middle East. They've acquired a company called Dabizzle. I believe they've acquired companies in Pakistan and Lebanon, Syria, Egypt, and assembled them. And they are generating phenomenal returns.
Not in Africa,
one of the disconnects.
Not in Africa, no, that's a good point too. Go ahead, please.
One of the disconnects is that when we look at companies and you see, okay, the disposable income of an African middle class is this, how does that compare with a subscription fee in England that you can charge £27 a month, for example, on LinkedIn, or £49 a month? The African person may not be able to afford that. But I think it has to be, you have to calibrate your investment strategy and what you're going to achieve at the local level, and the parity, the local economic parity or spending power, what they can buy for that dollar, what they can't buy in London. And you're not going to get, at the moment, I don't think you're going to get the Facebooks and etc. But you will get local heroes that will do phenomenally well at a comparative local level.
Right. And especially if you invest in Tencent, then your life is good.
Hi, Jim. This is Aniko.
Hi, Aniko. Welcome, Aniko.
Yeah, thank you. So I've been listening in for the last few minutes, and I actually do have a contrarian view, which I do think VC can work in Africa. Granted, I'm also a founding partner of a VC firm, but what I think was previous speaker was saying is how I look at it. And in the backdrop of me investing for almost 20 years now in Africa and over 20 years in emerging markets, is that if you think VC is Silicon Valley, it won't work like that. But if you adjust that to the Africa reality, which is inefficiencies in the environment, in the infrastructure, and lower income levels. And therefore you adjust and smaller markets, obviously. And so scaling across smaller markets is a lot more difficult than scaling within one single large market. If you adjust your business model for that, and more importantly, adjust your valuation at each funding round to that, I think you can actually build those businesses successfully and can create value. But what doesn't work is if you bring in your Silicon Valley thinking, your Silicon Valley safes,
Right.
valuations, way of building a business, that won't work. But if you are doing your what I would think standard African investment methodology, which is you're really very hands-on, you're there to support your entrepreneur every way you can. So it's a symbiotic, very active relationship. I think it can be a successful business model.
And I mean, certainly there is room for venture. I mean, just full disclosure, I'm a committed investor in Atlantica, your venture. So I certainly believe that there is room for venture capital. But again, I think what a lot of people have mentioned is that indeed you need to adapt the model and take a different approach or a more localized approach.
Exactly. And also focus on, I think Gita was mentioning very much, who are going to be the likely buyers of the business. It's going to be African private equity firms. And some strategics. IPOs are not going to be the name of the game. In my 20 years of investing, my previous job, I saw 2 IPOs coming out of emerging markets altogether, and one from Africa of the 2. I think that's going to pick up pace, but it's not going to be the exit option. So if your main exit avenue is to PE firms, you have to gear your business as a startup to be attractive to them. And part of that means you very much focus on not just the top line, but EBITDA and cash generation and getting to that point as efficiently and as quickly as possible. So you have to adjust it. You can think it's Silicon Valley type investing, but with those adjustments, thinking of how Africa works, I think it can be a very successful model.
Okay, very good.
Jim,
I think
Yes, go ahead, Sharnay. Go ahead, please. And Raj, you're right up next.
Okay, thanks. Well, firstly, thanks for hosting this. To Nico's and Gita's point as well, like, I think the venture model can work. I think a key thing to keep in mind is how we work towards building out not only the startup ecosystem, but the investor ecosystem. We are seeing more and more early stage VCs coming on board into Africa. I think recently I saw Local Globe made an investment into ULesson. But I think the key item which we'll have to develop further is the investor ecosystem for the venture model to work. As at the end of the day, if we're investing in these early stage companies, it's important to know who's going to be that buyer. As right now in the African market, it's mainly a corporate acquisition, which then sometimes stifles growth as well. Yeah.
Gotcha. No, thanks for that. And I think there are many different efforts to foster the investment ecosystem in Africa. Starting with accelerators and so on, but also a number of different investing groups, including angel groups. So thanks for that. Just a quick break before we go on to you, Raj. This is being recorded live and streamed live on LinkedIn and YouTube. So please, in case you didn't hear that earlier, keep that in mind. And this will be recorded, so you can access this later. And we're just a quick introduction from myself as well. My name is Jim Chu, and I run a company called Untapped Global. And one of our objectives is to create an investment network consisting of international investors and local entrepreneurs. And so we hold events such as this, as well as in-person and in-country events. So please, if you'd like to find out more and join our network and find out more about these kind of events, please, you can find out more at untapped-global.com. Okay, over to you, Raj.
Hey, Jim. First of all, thanks for having me on again. And first, I'm so excited because I want to share some good news with everybody. I've never heard from my healthcare center before. And today I got a message saying I've got my vaccine appointment on Saturday.
Woo.
So
All right.
I just have to share it with you, right? So apologies for that. But now back to the subject.
Well, wait. So does that mean that you're going to join us on one of our in-country investment trips? April 29th, 30th, Cape Town. You're coming, right?
I'm there.
Excellent. We're going to go talk to a bunch of startups and meet the entire VC network and hopefully get some more international investors into South Africa.
Yeah, for sure. But my point, actually, everything everyone said makes sense. The fact that it's not the same model as Silicon Valley. But I think the reality is that we don't know. Okay, so today things are changing. I mean, if I look at startups that I was looking at 3 years ago, coming out of Africa, pre-seed was never more than $1 or $2 million, right? And now you're seeing pre-seeds creeping up to 3, 4, 5, even $5 million. So you just don't know how this the landscape is going to change over the next 5 to 10 years. And the reality is that we don't know whether the VC model, or at least the Silicon Valley Western VC model, is actually fit for purpose in Africa. It isn't today, I truly believe, and I think I agree with what Aniko said. It has to be modified. But in 5 or 10 years' time, it'll be a completely different story, right? So the question for you as an investor, and I'm particularly talking to you, and I've invested in a couple of funds, is that what are our expectations on returns when you're investing in a fund, in a VC fund in Africa? That's the question we need to ask ourselves. I don't think it's the same answer if you were investing in a VC fund in the States, for example, in Silicon Valley, or even in London. So as long as if you calibrate your sense of return to that, I think we're all okay. And everyone knows, everyone who's investing in this sector, I think, is very well aware of the limitations in terms of exits and IPOs and stuff like that. But if we calibrate ourselves to what it is that we're expecting, then I think we'll be okay. But it'll change. I'm sure it'll change in the next 5 to 10 years.
Yeah, I'll agree with that. It's definitely changing. But again, I'm going to go back. This is Looney again. I'm going to go back to the fact that venture capital as an industry in the United States, it works as a whole. It makes money as a whole, but it only makes money for like 15% of the VCs. And for half of them, they break even, and for the rest of them, they lose money. So why would we want to copy that model? Why wouldn't we want to find a better model?
Looney, if I can pick up from what you're saying there as well, Raj, the thing is, change is constantly happening. So even when we look at Silicon Valley, that has experienced significant change over time. And there were a unique set of circumstances with the enabling environment, with the incentive structures that were given, and also to some extent, by the way, I think also a lack of awareness by many who were coming into the ecosystem in the middle, I think, which helped to get to scale. So I struggle with this concept of, is Silicon Valley type VC the right thing for Africa? Because my starting point is, what is the financing gap? What are the needs of businesses on the continent? And that, unfortunately, has not changed much. Not in the last 15 years, not in the last 20 years, not in the last 25 years. The gap is just huge. So the question, when I think about this issue, Jim, I think about whether we're framing this in the right way. If we're talking about how best can you invest in Africa to get strong returns, you need to start with what do strong returns look like, right? Usually, we presume if it's earlier stage businesses, you want a much higher return for the risk that you are taking. Well, on the PE side, the risk premium for Africa is about 17%. So your starting point of understanding what you're expecting as a return is so fundamentally different. I agree with everyone who's here in that I do believe that both VC is possible, VC is right, but also that VC needs to be done differently. But I think that's because almost we're comparing the US, one country, and distinguishing between what's happening in Austin and what's happening in Miami and what's happening in Silicon Valley, to an entire continent where, yes, NAFTA is there, global. If you look at at Local Globe as well, that's a South African father and son duo behind that, right? We've got great businesses who've had significant history within a more stable sort of economic system in South Africa, especially over the last 20 years. But that's very, very different to some of the more exciting places some of us are investing in, including places like Senegal, including places like Rwanda, etc.
Yeah, I mean, just adding to that a little bit, I think going off of what you're saying, Looney, and this is, I think, my concern for Africa, which is, yes, you may have some opportunities for venture capital and some returns in venture in Africa, and I certainly am an investor, a venture investor in Africa, but it leaves out such a large portion of the market, and I think there's other opportunities if we are a bit more creative about how we invest in the African economy. In a sense, and I said this phrase before, but we need to learn how to innovate on how we finance innovation. So I think that's really the challenge here. Rilwan, I know you've been wanting to say something. Rilwan Miran, please introduce yourself a little bit before you jump in.
Thanks, Jim. Really appreciate it. Thank you for inviting me up here. So I'm the head of impact investing for MassMutual. We put out about $100 million a year in impact funds. I also run an early stage, $50 million early stage VC fund. I've worked most of my career, close to 20 years in emerging markets in both venture capital and private equity, including I've had the great chance of funding one of Jim's businesses in Haiti.
Thanks for that, by the way.
Which was a phenomenal investment. Jim, just a couple of thoughts. Given that I've worked in many different regions around the world, and I've looked at Africa as well. Africa is such a big continent. There's different regions and markets that I'm not sure one recipe fits the whole continent. And what I've seen is in certain sections or certain countries, a VC market, if you're trying to get a 15 or 20% cost return on your investment, in many of these places, you're literally competing versus commercial banks, and that's not the area you want to be in when you do investments into private companies. Other markets are more robust, like the Maghreb region and so forth, where there is a more robust M&A market, and more European countries are more apt to acquire companies in those markets when you do private equity investments. So I think what I've seen works is flexible capital. You can do VC in a number of these markets, but you have to be flexible. I think you have to be open to more non-dilutive structures like self-liquidating or revenue rights, and structures that are not kind of baked in the traditional kind of preferred equity structures of the VC model. I think if you are flexible in some of these markets that don't have a public kind of avenue for exit or a robust M&A market, I think you still can get your returns, and you can find those gems in those countries.
Well, thanks for that, Rowan. So I think, we talked a lot about is it the right model, et cetera. And I know that was the question in the subject line, but I think my interest is really much more on the follow-on question to that, which is what are some alternative models? So I'd love to hear from this audience, because I know specifically there are people who have been innovating quite prolifically in this audience on what are some alternatives to the cut and paste Silicon Valley model for investing.
Just wanted to chime in, if I may, Jim.
Yes, please, Stefan.
Hi, Stefan Brabham. I've been working with UK pension funds in private markets for over 30 years, investing in Africa for over 20 years. Never invested in African venture, but then in 30 years, I've never invested in European venture, and I'm based in London. I get a lot of stick from that for that from time to time. But it seems to me the consensus is, well, actually, the VC model ain't working for the US. I forget who it was who said it, that it's only working in a few cities. I did a talk on this in Australia back in 2013, and I actually said it only worked in 3 at that point. The Valley, maybe Boston, and maybe New York. In the UK, we tried to have 4 hubs. We had London, we had St Andrews, we had Cambridge and Oxford. Of course it didn't work. So I think first of all, there's a problem that it doesn't work anyway. Then when we're coming to Africa, it's 54 countries. That's a cliche. The US is 50 states, and it's actually, in some ways, it's more fragmented than Africa. But the big problem is, whenever I speak to LPs, and that's my day job, these are the guys that pay me. If I put forward a model that's slightly different, they get suspicious. And the reason they get suspicious, and I'm not having a dig at GPs here, but anyone who's been in the industry for any length of time, 90% of their education has come from GPs. And the GPs have told them, this is the way it's done. It needs to be a GP LP structure. It needs to be there needs to be no hurdle for venture, and it needs to be 2.5 and 25. And the LPs have just been indoctrinated with that. So before you start thinking about different models, you've got to consider, are they going to be comfortable adopting them?
Yes, that's
So
a
my-
really great point.
Oh, yeah.
My contrary
Stefan.
point to that is a really good point, but the reality is when you go to potential LPs having gone through this road and think of different structures, it falls on deaf ears.
Yeah.
I would say 99% of the time. And putting those different structures in an Africa context, you lose them altogether. So I think what you see, this cookie cutter approach, is because on the LP side, there's little flexibility, not necessarily because the GPs can't think creatively. It's just that creativity is not supported by the LP community. And I think partially is because of the nature of the institutions that are LPs in Africa at the moment in time.
Yeah, and I'll say it's 98% because I'm actually doing this. So
Great.
diving into solutions. And I have 2 solutions for the world,
Yes, let's
not
hear
just
it.
Africa. And so the primary tool that my accelerator uses, Fledge uses for investments, is revenue redeemable equity, revenue-based equity, revenue-based finance, royalty investing, however you want to call it. There's no consensus on that. And the structure we found was really simple. We buy shares, just like an equity investor buys shares. We don't fret over the valuation too much because the company then is obliged to buy back half of our shares, not all of them, just half. And so we have a price that's set at the time when we buy the shares, and we have a percentage of revenue, which we use 4. As long as it's a single digit, it's fine. So they take a percentage of their revenue every quarter. That determines how many shares to buy back. So we just take revenues divided by, revenues times 4% divided by share price, round down, so we don't do fractions. And that's how many shares they buy back each quarter. And eventually we run out of shares for them to buy back. We happen to pick a 2x return for that investment. So it's 2x on half the investment. And then we still have some shares left over. So we still have some upside. We're still playing the VC-like game, except when they're done buying back the first half of the shares, we can ask them to buy back the second half of the shares because there's no exit. So why would we wait for an exit? And those shares, they get bought back at whatever they're worth then. So we then have the upside growth of whatever happened in those 5, 6, 7 years of growth. And we're just hoping we get another 1x on that, which to be, doubling the money because it's half the investment. And that would then give us back the same return if this all worked out, and we're not old enough to say it works out. But it seems to be working out. If it all works out, we make the same exact return as a VC fund. A little higher IRR because we're getting cash along the way. But cash on cash, we get the same 2 to 3x return as a successful VC fund. We've done that deal with 100 companies in 24 countries, mostly Africa, but also Philippines, Republic of Georgia, down in Latin America. And this is the same thing we do in the US. So we don't need these companies to be in one of 6 cities. They can be anywhere in the world.
Yeah, Looney, I've seen that work as well in different parts of the world. This is what I meant when I mentioned revenue rights and self-liquidating, exactly what you just said.
Yeah. So going back to Stefan's point, which I think is a good one, which is, how easy is it to sell these alternative models or these somewhat non-vanilla models to LPs?
It's a pain in the ass because you gotta describe it to everybody in detail.
But
every
I think
LP, you got to describe it to every entrepreneur too, because they've never heard of it either.
Well, actually,
but the reality here, Jim, thanks for the invitation. So I'm based in Zambia, and we've been doing this for the last 20 years. And our approach has always been, this is an art, it's not a science. Ultimately, what you have is an entrepreneur trying to get their business running. and they know access to capital is difficult. So they will work with you with a model that they know that they end up where they wish to be once that investment has been done. I mean, when I started my career, we had, and I know the focus here is VC and tech, which is the in thing at the moment. But when I started my career, we were putting up a shopping mall in Lusaka with blue chip tenants, and nobody would fund this property developer, but they would fund the farmer because there's all this DFI money that was there.
Yeah.
And he would put his money into the ground and pray that it rains so that he can get his return. But nobody would fund against Barclays and ShopRite and quality tenants. And I remember we did that deal in lieu of fees. We brought in the contractors, paid them a third cash, which we raised from Barclays because they wanted to be in there, and 2/3 equity. That was the second shopping mall built in Zambia by Zambians. 3 years later, the debt was paid off. It was an $8 million development. And this was in 2004, 2012, we sold that mall for $25 million. And over my career, and it ranges between advising large corporates in Zambia, investing our own money in businesses, or supporting small entrepreneurs, we have seen the local evolution of this, as opposed to focusing on a business model that is Western based, because that's where we all run to raise capital. And how do you address this with sort of homegrown talent, tapping into the local markets, helping the pension funds reform? Zambian pension funds, at the moment, 80% of their capital is sitting in government paper and bank deposits. It just doesn't work. And our focus over the last few years has been, how do you make that reform happen? So you're doing private equity in local currency, or you're doing a VC fund setup in local currency. Through that whole journey that I've been on, we were at a point where we had 300, 400 employees. We did everything from shopping malls. We brought the first digital cinemas into Zambia. We had franchises. We brought Pizza Hut into Zambia with Zambia, Mozambique, Zimbabwe. Ironically, if you've been to Zimbabwe, the Pizza Hut that's in there, we took that there. But ultimately, I think the starting point has to be, are these businesses sustainable? How much of local capital is available to play? And then, is there scope for expansion? And what we found when we started exiting these businesses is you find the continent is very fragmented. For the most part, a lot of us are not inventing anything new. We are effectively just replicating what has been done elsewhere. There's big talk about leapfrogging. I found out how expensive leapfrogging is in Africa. But I think apart from Safaricom with M-Pesa, we need to find something that is homegrown in Africa, supports African businesses, and can be expanded across the continent. And I've heard a few people sort of say this, that touch on this, but to look for a solution from Silicon Valley into Africa, my personal view is we just never work. Each of the markets are very different. They found their own solutions. We do transactions in the SADC region, and you can see how diverse our creativity is. And then it attracts in international capital. So that was, and Jim, thanks for the invitation. That's the first time I've spoken on this platform, so I was a little bit nervous, but thanks very much for the invitation.
No, Cesar, I'm really happy that you spoke up, and it's really good to hear that there's some good success stories around breaking the Silicon Valley mindset. I mean, there certainly are opportunities applying that model, but gosh, I think we're ignoring such a huge opportunity in the rest of the market. So I'm glad to hear your success.
You have some great people here. I know Raj very well. Hopefully that job he's going to get, he can.
Wait, I'm sorry. Who doesn't know Raj? Who doesn't know Raj?
Thanks very much.
No, thank you. Thank you. Great. So, here I see that we have a number of new people. Luam, Marco, and Tony have joined us. Slavomir as well. Love to hear from you guys as well. What are your thoughts and what are your solutions?
Hi, Jim. Thanks for the invite. Good to see you here and everyone else. This has been super interesting. I'm Marco Casas. I've been doing the US VC model for about the last 5 years, but before that, I was actually at Standard Bank for a while, and I come from Latin America and lived in Swaziland for a couple of years, and did some other emerging markets like Russia with Renaissance Capital. So my past speaks more to the problem of exits and trying to be in capital markets and M&A as well. One thing that I've seen play out recently through mainly family office kind of context is when they found an investment in Africa, and this goes a bit back to something that Nico was saying. It's just getting to that profitability and the fact that there is, a market and people are spending money and there are opportunities for outsized returns. What I've seen is once there is a small investment, say, kind of maybe below $1 million, maybe 500K, once a company starts showing that exponential growth, I've seen rounds being preempted, and then just a big jump from say 500 to $4 million. And what that lead investor has done is syndicate that entire round and then just run with it. So it's not something that commonly happens in the US. So I was wondering if people, any of the speakers had any views on that, and maybe the idea is here, can that investor have that lead responsibility of being super hands-on, preempting when the next need is, and also helping put together a round of that size, and just kind of like taking that off the entrepreneur's plate. But yeah, I'll stop there for now. Thank you.
Thanks, Marco. Anyone have thoughts or response to Marco's comment question?
Hey, Jim.
Go ahead.
Who's that?
Christoph, go ahead.
Yeah, Christoph. So I'm the founder of Africa Arena, and I'm running a venture studio in Africa. We're based in Cape Town, and I've been doing venture development in Africa for a few years. I think I like to think of the question as it's a food chain. So is VC the right model? Well, VC works for a certain class of deal, and I think it's needed as part of a food chain. You need a VC transaction to buy certain types of investment at certain level of maturity, but the ecosystem is very early stage, as you know. The needs really are in the seed to Series A, which is largely unattended by the VC investors, simply for the reason that many of the speakers before have mentioned. It's driven by the LP. They need return, they need critical mass on transaction, and nobody wants to do small deals, on the VC model. So I think the alternative to that, in my opinion, something that has worked well in our case is venture studio. So, which actually has been sometimes the case of some of the examples that were discussed. Naspers actually being one of them, but outside of Africa, where you get involved in the build and the seed funding, and because capital is not enough. In Africa, you need a lot to navigate 54 countries, scanning in Africa and outside of Africa. And that's why I think you need more than just the VC component, especially if you start at a low base seed level, which is where the money is required now. And many LPs don't really understand that yet. The other thing I would suggest is venture debt. So I think there's really a case to make that there's not a lot of options in venture debt in Africa. And I think there's huge market opportunities there. The startups cannot raise from banks in terms of debt instruments. And so they are constrained to go to VC. And it's actually quite an expensive way of raising capital. So,
Indeed,
I don't know, anyone interested in that?
Well, so, and by the way, and that's what Untapped does, right? We focus on venture debt for certain kinds of ventures that are asset heavy. So definitely, hopefully we can jump in. And I think there are a number of different folks on this on the stage that have solutions as well. And Annika, you had something to say?
I was just going to actually plug you for that one, which is completely missing in the space in Africa. Venture debt or any kind of non-equity type instrument. You see this in the PE space a little bit. I used to do that a lot in my previous job in kind of what I used to call mezzanine instruments. That could look like equity or could look like debt, depending on what was the need of the underlying company was, but it's completely missing. startups, as they scale, they get choked with working capital. Inadvertently, raising equity is a very expensive way of doing it. Every startup has this issue if they're successful, and if not as well. And there's very little solution for that. And you guys are one of the few who are offering this on the tech startups and companies that have some assets, and that's one great way of accelerating the growth of the companies without really having to dilute the entrepreneurs and the like. But what I find is that the knowledge is very little in the entrepreneurial space, I think, because those products are not really out there. So even in our conversations of trying to convince our startups to use some of those instruments, it's a bit of a hill to climb to explain the benefits, because
Absolutely.
The US VC system is so embedded in the minds of entrepreneurs that it's hard to get them to look at other.
And I think also, it's hard to convey the idea that equity is expensive, right? I've had a lot of people say, well, what do you mean equity is expensive?
Yes.
I think there's this idea that, oh yeah, I just raised a bunch of money and it's really easy, and then I'll be able to grow to whatever I want.
But you don't have to pay it back. It's cheap because you don't have to pay it back.
Right. Well, that's the idea, but there are other costs to it, right? But anyway, we can really go down that rat hole.
Yeah.
But Looney, I know you've done a lot around innovating here, and you described the model. I mean, I'd love to hear from you on where you intend to go with that. What's your longer term vision? This is a question for Looney.
Oh, sorry. With the revenue base, actually, for most of Africa, I've thrown it out. So I do think it's the right model in almost every case, but I found another model that I think is better for what I'm doing in Africa. And it's an older model and a simpler model, and it's the holding company. And everyone here probably goes, oh yeah, that's been tried. Not in the way we're doing it. So what we did is I run an accelerator. We made a whole bunch of investments, 40 something in Africa. 27 of them are in food and ag. So last year, we took those out of our portfolio, out of our VC-like portfolio, and we traded that for shares in a brand new Mauritius holding company. And that holding company went out and raised $1 million, and we're out raising 7, 8, 10 million more this year. And the holding company then distributes the cash in the most efficient manner across the portfolio. It's permanent capital. So we make equity investments to do some debt as well, but our goal is to always own these companies forever, never to have them exit, never to have them be acquired. If it happens, it's fine, but we don't need it. And instead, we're taking the entire holding company public. So we want to be like Berkshire Hathaway. We're 99.9% smaller than them at the moment, but our goal is to be $100 million public holding company by the end of the decade, listed in London. And our sub goal before that is to be a $20, $30 million holding company on a few African exchanges before in 3 or 4 years. And by the time we get to London, we expect we'll own pieces of 100 companies or so. And on purpose, it's pieces. So generally holding companies are used in the PE world to buy up a bunch of companies and build conglomerates. We have entrepreneurs. We like entrepreneurs. We're just supporting the entrepreneurs. They're all there. They're all running their companies. We're just the financiers. And so we're about 6 months, 7 months into this. It's working really well. And I expect there'll be a whole bunch of copycats once we prove it out.
Great. No, I love seeing that innovation, and I'd love to hear from the others. But I want to go back to a previous discussion about, a lot of this is about educating LPs and getting LPs and how easy it is to sell to LPs. So, posing a controversial question, are LPs the problem? Do we need more local African investors, and how do we do that? Anybody want to jump in with an answer, a solution? Vision?
One of the
a quick question. Oh, sorry, Stefan, please go.
One of the issues is people talk about the African pension fund market. It's 300 billion. Well, it is, but 250 of that is South Africa. and they're only allowed to invest 5% of their portfolio outside of South Africa into other Africa, and they ain't going to put all of that in into private equity. Some of it will go into public markets as well. The next biggest market is probably Nigeria, and I think given where the Naira is, it's probably only about $15 billion. It really isn't that big. You've got a pension fund in Namibia, you've got one in Botswana, one in Angola, you've got a big insurance company in Kenya, you've got a big pension fund in Ghana. There's not that much money there. So we do need to be pragmatic about that. And I know a few people on here have heard me whine and moan about DFIs, but we do need to respect them for the job they have done, and they're still the biggest players. And my comments about LPs being dependent upon their education from GPs, we all need to do a big job on helping the DFIs and get them better placed.
Yeah, and I know, Geeta, you wanted to say something, but Anika, I think this is a perfect segue for a comment from you because of your background and at DFIs, at a big DFI, and also, you know, your view on alternative investment asset classes.
Sure. So the backdrop of it is that I used to work at IFC and run their technology, media, telecom group globally. And the DFIs are very active in the continent, and I think it's a great thing, and I think it should stay like that because their money, I think, plays a vital role in the development of the continent altogether and economic growth. Their role is a catalyst role. So what would be nice to see is for the rest of the ecosystem come in and support that and follow on the catalytic role. So I would say it's great to have them. It's good, but it would also be nice to have things that, let's say, if I look at the Latin America, there's a huge kind of family office structure in Latin America where the family offices invest within the continent. They don't look necessarily to other jurisdictions to diversify away. They believe in the story, and then therefore fund startups, funds and the like. We don't really have this in Africa. You don't have local money supporting local efforts. I think that needs to develop a little bit so it can be complementary to what some of the DFIs are doing. I think we should be careful, and we don't want to wish the DFIs away. I think they play an important role. It's just that the ecosystem then can supplement what they are already doing.
I'd love to hear, because there are some African investors on. Tomi Davies is also on, as I see. Love to hear, Tomi, your thoughts on how do we get more African investors involved in alternative investment classes. Tomi, are you there?
That's what we spent the last decade trying to do. And when we looked at it, immediately it became apparent that the VC model wouldn't, well, I didn't think it would fit. I'd stumbled upon early stage investing anyway, so it wasn't as if it was by design. But when I started studying it, the closest thing I could find to what I was trying to do, which is focus on founders, was angel investing. So we started the journey on angel investing, and found very quickly that you needed networks to make it work. So we started the Lagos Angels in 2012, started working on that. And one of our startups had to go out of the country, and we couldn't find anybody to help us do that. So that's when we found, through Ben White and others, that guess what? There's only about 5 of you guys across the continent. So in 2015, ABAD was born, and fast forward to last year, we now managed to have, I think, something like about 50 networks in 33 countries, but it's still a drop in the ocean of what's needed. Just to set it in context, the Lagos Angel Network, which is one of the more active ones, did 12 transactions last year, averaging about $250,000, $400,000 per transaction.
Hey, Tomi, any idea on how much is the angel investment in Africa in total, more or less?
In total, it depends on who you talk to. I've heard because Brighter Bridges have done some work and a few other people, but I reckon we're probably at about a 200-300 million mark.
To date, not annually.
No, Raj does that
Sorry?
on his own.
I beg your
To
pardon?
date, not annually.
Annual.
Really?
That would be last. Well, when you consider just Nigeria, Angel in Nigeria last year was topped 5 billion. It was going north of that. South Africa is more prolific, and you look at what Cairo Angels are doing at Victoria Business Angels, and yes, I can see how we'd arrive at those numbers.
Interesting. Okay. I know, Geeta, you had some comment. Thank you very much for
Yeah,
that.
I just wanted to
but
those are
echo what,
guesstimates, by the way.
Okay. Those are guesstimates. Gotcha. So interesting. So Liz, you were just about to say something. Go ahead.
Yeah, hi. I just wanted to echo what Tommy was saying, as well as Christoph. So I run an investment advisory out in Kuala Lumpur, and I work a lot with Asian investors, promoting investment onto the African continent. And just to speak on the topic of discussion, which is whether VCs work or not, from my experience, I would agree with Tommy in the sense that we have actually had more angel investors from Asia being interested in Africa rather than VCs. A lot of VCs don't really want to touch Africa because of, again, the same model that is being replicated across the world, which is the Silicon Valley one. So I think I would have to agree with Christoph in terms of looking at what works for Africa. For me, I would think angel investment and as well as venture debt. That's just my opinion.
Hey, I thought I was the only Malaysian on this channel. What's happening?
Hey, Raj, well, I had no idea you were in Malaysia as well. Good to meet you.
You've both been on the same discussion elsewhere. How can you connect?
Really? I had no idea. Oh,
If
we
I
should
can
definitely
jump-
connect, Raj. We should definitely connect.
Yeah, please do. Yeah, let's do that.
Slawomir. Oh, we have several people there. Slawomir, why don't you go next, and then Tommy.
Yeah, I just quickly wanted to follow up on basically what Liz said, because when I used to be in venture capital and I was an investment manager and I wanted to show an investment in Africa to the partners, they were too scared of it. So it's also because, like, obviously as a European looking at a different country where everything works differently, it's a challenge. And now basically I have a startup, and like we started fundraising from European investors and talking to them about Africa. And it's like the mentality at looking at the continent. First of all, it's like if you said like you are scaling something in Europe, but you don't because you cross the border to a different country, and it's a whole different scenario. So I think like this is also the challenge that.
Hello. Oops, sorry.
Yeah.
Got it.
Yeah, I just wanted to wrap up. So basically, I think that's the challenge with many VC funds that, as Liz said, they look at it through an optics of a Silicon Valley investor, and they expect it's going to be the same, like investing in a company that's going to scale across the US, but it's a whole different ballgame.
Right. And again, it's just that applying that mindset from somewhere else to a market that may not be optimal for that mindset. I know, Tommy, you had a comment?
Yeah, I just wanted to talk about an experiment we're running. For my sins, I'm the Chief Investment Officer at Green Tech Capital Partners in Frankfurt. And what we're doing is we're actually building a platform that would enable European investors to invest on the continent, but in a totally different way, in that they'd only be picking out of stocks that investors had already invested in. So their due diligence would sort of be secondary on top of what had already existed. And it's interesting how it'll be interesting to see the reaction to that as the platform comes up later in the year.
Indeed.
Yeah.
Indeed. I mean, again, just echoing some of the comments about, how do we educate LPs and potential investors, and who are they? I think that's at least one of the conclusions from this conversation I have is that's one of the big issues to address. I think, Anthony, is that right?
Yeah, I just wanted to ask a quick question for everyone. We're a small venture firm based in London, and we're looking to expand more so in Africa. What would the speakers suggest on the best avenues for, whether it be us investing through a VC fund structure or directly to startups that need capital?
I'll give you a few comments. And the first thing is you've got to speak to the DFIs. Second thing is launching with a fund with no track record is a big ask. And what would be a better way to do it is to try and get a couple of deals under your belt with your own money or friends and family money. Once you've done that and you can show you've cut your teeth there, then try to do a couple of club deals. Again, speaking to the DFIs and a few others, they'll be happy to do club deals because it means they're spending less on fees, and then build it up gradually. So patience is the key
Is
word.
that strictly in Africa you're speaking? Because we have a presence globally. In Africa, we've invested in a few VC funds ourselves. So you think directly with the DFIs, yeah, that'll be the best?
Well, I would,
not
Go
just
ahead,
the
Sam.
DFIs. It's a good place to start.
I would say go talk to Amiko at Atlantica, who's on this call, and also talk to Looney, who's doing some interesting, innovative things in Africa as well. But I would also talk to Caesar, who chimed up earlier about some of his on-the-ground efforts.
I'm
And
gonna
please
chime
come
in and
talk to us as
say-
well.
Yeah, I'm going to say neither of those two, at least not in the form you're thinking. For 9 years, I've been running accelerators, and there's a huge difference. This is subtle thing that's not talked about in the industry. In the VC model and the angel model, the default is no. You're going to see deals, and your default is no. I'm not going to invest in this one unless it's perfect. And so, typical VCs, we're talking about VCs, right? They'll look at 1,000, 2,000, 3,000 deals before they pick one. In the angel model, in the accelerator model, our default is yes. Our default is we want to help every company we see, and they're all flawed, right? And this is the problem where the VCs and the angels look at them and they say, well, I can't invest in it. It's got a flaw, got a red flag. It's got a bunch of yellow flags. In the accelerator world, we know they're flawed.
Please remind me to talk about Catalyst. Please go ahead.
So we start with this idea that, yes, of course they're flawed. That's why they applied to an accelerator. We'd love to help them all, but we can't because we don't have the resources. So we're going to pick the ones where we can fix the flaws. And in that model, and how it flows out is great. We find companies that everybody else passes on. We fix them. And in exchange for the help and the early money, we get an outside ownership piece. But it also creates a relationship with them because we've done the work to help them. We're not just writing a check and promising some help. We're doing a bunch of help and writing them a check. And so reach out to me. I'll explain how this works and how this is better in more detail.
Perfect.
Thanks,
Sounds
Looney.
good.
Hey guys,
Sure.
Jim, do you mind if I jump in for 2
Yeah,
minutes?
please go ahead. Who was
This,
next?
I'm sitting here in Hong Kong, and having worked with these Hong Kong family offices and actually brought a few. Like I was very lucky to visit Kenya in 2015, met some really good friends there, and then since then sort of tried to expand my entrepreneurial coverage in Africa, especially I guess East Africa, and then sort of connect them to Asia. I personally believe that the next 10 years we're going to see a huge amount of capital inflow. We're already seeing at the infrastructure level between Asia and Africa. But I think that the other unique difference is that the economic development model of Asia is, very dramatically different. There's this really interesting book I'm reading right now called China Super Bank. And it's basically the story of China Development Bank. They basically bootstrap the country using kind of real estate, like government real estate, in order to build enough, in order to borrow debt, and then they built infrastructure for that, then increase the equity holdings of the land. And that's how they sort of bootstrap out of poverty. And I think these types of models are not so readily apparent in California, where it's very much about sort of like building on the top layer, right? And I think the infrastructure piece is where there's a huge amount of money and value to be created, because honestly, sitting here, I see that Africa has abundant natural resources and terrible tertiary value capture. And there's like watching like
Dangote in Nigeria, build the world's largest cement factory because he's, unhappy about the fact that they have to import all of their cement, and now he's building the world's largest oil refinery. I think those types of opportunities are unparalleled here, and it's a different type of infrastructure investments or a different type of investments in general. But I kind of believe that that's a very substantial part of where Africa's growth is going to come from. And once these base pieces are in, along with the sort of new financial rails that don't require you to pay, the monopoly wages to, the Visa and MasterCards of the world. I think these are two very incredible drivers for value creation.
I'm backing up
Thank
what
you
Max
for
was
that,
saying.
Max.
Just
Go
want
Tan,
to
then I'll
add
go
to
after.
Yes,
just
go
want to add
ahead,
what
Shoma. Go ahead.
Yeah, I wanted to also, sorry, you're going to call me Mr. Experiments. I also want to talk about something else we're doing, and it's come from Looney's talking about accelerators and what my friend was talking about earlier. And that is a program where we're bringing the innovation hubs, accelerators, and incubators in major cities together with the angel networks. And the way we're doing that is if an angel invests at a certain stage in startups in those hubs, then we actually do a matching grant to start. We're testing it out with matching grants. The aim being to do co-investment going forward. Right now, we'll do up to, there's small ticket items just to test the model, and it's up to 60K euros per transaction. I just thought I'd throw that in just to say there's a lot people are playing around with to see which models are actually working better for the city-centric construct that is the Africa continent. Everybody focuses on nations, but Africa is actually a continent of city markets, and that's the way the continent is structured.
That's
And that's
AfriLabs,
open
isn't it,
to
Tony? AfriLabs.
Yes, that's in collaboration. That's between the Africa Business Angel Network and AfriLabs. Yes, that's correct.
Yeah, and that's available
The first
for
the first
Pan-African?
LP. Yeah, it's across Africa, and the first LP is the French Development Bank.
Gotcha.
Hi, Jim.
Thanks for that.
Sorry, I've
Go
just
ahead,
going to
Tan.
raise a point on what Max was saying, is that you have very large infrastructure projects going in Africa. At the moment, they're Chinese. The Japanese are going in, and quite a few Indian companies are also going into Africa. And of course, some of the Europeans and Canadians. I mean, in the Middle East, you see when companies get very large contracts, they have to create offset programs. In the case of defense industry, there's a lot of offset programs in Saudi Arabia, UAE, and many other countries. Perhaps, people like Aniko and you could convince the IFC and the international funders that when they do provide funding for these large, gigantic infrastructure projects, the offset programs could be used to create these accelerators and venture funds, and that would also then help people like Stephen.
Tying
Thoughts
in
on
with
that,
what Max
Aniko?
and Tan were saying there. I've been talking just a little bit briefly with some just secondhand with things with some of the policy wonks. They've been saying that there's USA is getting a little jealous of all the Chinese investments in Africa and trying to look if there's more support of a more formal level they can basically level here. One of the things is that historically, I think they've been a little unhappy at some of the how the older models turned out, just large governments giving other large governments lots of money and questionable how much of it actually ended up having long-term geopolitical goals essentially with stuff. But the reason why I bring this up actually is I'm a part of this smaller it's called Helpful Engineering. It's an engineering group, got about 10,000 engineers or so, and it's more of a volunteer organization. What's interesting is they're up for a grant with BARDA essentially for managing it's a weird setup. It's a public grant, but essentially they have a $500 million development fund that was essentially set up for investments in actually venture capital, as that essentially as the government's providing the money, but it's being managed essentially by a firm. So the government's essentially acting as essentially an LP of sorts, which is weird. It's a very unique kind of model. We're not guaranteed to get. There's 12 other groups that are on the table for it. We'll find out in the next week or two. But one thing I just wanted to throw out there as a consideration. I know development finance has a lot of different nuance to it and other aspects, but one thing I'm kind of curious is that as there starts to be more geopolitical movements on the continent with Africa, is there an opportunity potentially for some of those like more LP type kind of models to be used, but the management of it is actually more with like accelerators and venture capitalists is actually the deployment of the funds rather than going from a state-based agency model? Just throwing it out there, it's just an open question.
Great question, but I'd love to answer that. I'd like to also get Aniko's views on some of these. Is she still here? Oh, she might have dropped off already.
Sorry, Jim, if I can perhaps take a crack at that one.
Yes, please go ahead.
Can I just say, when it comes to managing global geopolitics, I like the Djibouti. I really like the Djibouti model, because what they do is they take the funding from whoever is in their best interest. So as a result, you've got Chinese funding in there, you have US funding in there, you have European funding in there, you have French funding in there. So for me, I'm more driven by, excuse me for being quite blunt about this, but I'm more driven by finding the capital that suits the business and the entrepreneur. So on one hand, it's really tempting to try and figure this out from a general ecosystem perspective with the LPs. But I'm wondering to what extent there is data currently available on the performance of VC on the continent, where the volume of capital raised is not the only indicator of success.
Yeah, that's a good point. I think we need definitely a lot more track record and focus studies on that. No, appreciate your comment there, Gita. Well, before we continue, just a note, we are 10 minutes past the hour, so we're a bit over time. Did want to thank everybody for joining here. We're not going to end the session. We're going to keep this room open in case any of you want to continue the discussion, but I do want to make sure that no one feels obligated to stay on, especially some of the panelists. So thank you very much for attending the session and being part of the conversation. We host conversations like this around entrepreneurship and investing in emerging markets, in particular Africa, every week on Thursday at 8 a.m. Pacific time, 11 a.m. Eastern time, and 4 p.m. GMT. So please join us back here in the Invest Room on Clubhouse. And we also broadcast and stream this live on YouTube and LinkedIn. So if you don't have Clubhouse, please feel free to join us here again next week. And if you'd like to find out more about our in-person, in-country, as well as virtual events, please go to untap-global.com, where we have a slew of events coming up in the next months. That's it for me. My name is Jim Chu, and thank you for joining us. And for those of you who still want to continue this conversation, let's go for it.
Jim, thanks a lot. Thanks, Jim. Listen, Steven,
Thanks, Jim.
I wanted to say one thing before.
Thank you.
If anyone's staying around, I wanted to say one thing, which is that everyone talks about different models in Africa and how difficult it is to adopt them. The one thing I would say is that whenever you say it's a Y Combinator model, everyone adopts them. So we just need to give it a Y Combinator and tell them to say that this is the model to use, and everyone in Africa will follow it.
So we call it the Looney model. We just call it the Looney model.
No, I'm nowhere near as
Very
famous
good
as
point,
Paul
right.
Graham.
Whatever sells.
Yeah.
Well, we have something called Smart Asset Financing, which is our IoT-based asset financing model for SMEs. So keep that in mind. That's the key phrase for today: Smart Asset Financing.
I'd love to do a promo at the end too, since we're done.
Yeah. Are we done? Are there
I
other
don't know.
comments?
I'm sticking around till the next hour, but for the audience here, if anyone's interested in being an angel in Africa and hasn't dove in yet, isn't an A-band member yet, I'm running the Angel Accelerator with the new AVPA organization. That's the Africa Venture Philanthropy Alliance. And we do weekly free webinars on Wednesdays. You can find us at theangelaccelerator.com.
Great.
Say that again, sorry. Angelaccelerator.com.
Theangelaccelerator.com. We're taking the learnings from startup accelerators and applying them to teaching angels how to be angels.
And what's the model? And what's the model?
It's a 10-week hands-on class. You commit $5,000 ahead of time, and at the end of the program, you will have invested it.
Oh wow! Okay, that's kind of cool. I'll take it up.
Great.
Is it
Well,
online?
Yeah, it's
Did you get-
virtual. It's all virtual. It's on Wednesdays. There's 2 of them, one for Africa, one for the US. Pick the time zone that works for you.
Okay.
So before, and again, we can continue, we'll leave the room open, but any last words from the panelists and anybody else who's on stage? Gita, you want to go first? Final thoughts?
Final thoughts, I think, I hope what we've had is a very theoretical conversation. The starting point anyways, when we started with is VC right for Africa? Because I think we all agree that there's a need to have VC on the continent. So just a final thought from me is I think it is absolutely fundamental to do 2 things. One is genuinely to unlock capital from the continent. If you think about it, less than 5 billion was invested in the space in the 5-year period between 2014 and 2019. So even with the numbers that Stephen broke down for us, I think there's very much capacity on the continent, which is increasingly being unlocked. That's going to be important, including getting angels from the continent to invest within the continent. The second point for me is just making sure that the entrepreneurs that we're backing are entrepreneurs who are really embedded within these ecosystems. So for that for me is a call, and it's a very deliberate approach that I have to invest in African entrepreneurs.
Thank you, Gita. Thanks for being on. Thanks for your thoughts. Anyone else? Looney?
Yeah, I'll bring up one thing didn't pop up, but kind of popped up earlier today. Just this idea, somebody said, why don't the investors take the burden off of the entrepreneurs of finding other investors or finding other money? And this is something that's in the VC model that just doesn't seem to be known unless you've raised money from them. So I spent 20 years as a software entrepreneur. I've raised money from California VCs. That's where I learned this model. And the way it works down there, literally, I'm in Seattle, so we'd fly down, we'd find a VC, it would take us 2 or 3 trips. And then when they gave us a term sheet, we'd be asking for whatever, 7, 10, $15 million, and they'd say yes, but they didn't say yes for everything. They said yes for exactly half. So if we were raising $10 million, the term sheet said, great, we'll lead the investment for $5 million. And then it went on for 5, 6 more pages. But then what they did next was that they gave us a list of other VCs to contact, and they would do warm introductions, and we would go back on the plane and we'd fly down again. And one of them would follow the deal for the other half. And that's missing in impact investing. It's missing in every African investment I've seen everywhere outside the US. This idea that it's the job of the investor, the lead investor, to find the rest of the money. It's not the job of the entrepreneur. Because if they gave us a list of 8 and all 8 said no, they gave us another list. They didn't just give up and said we're done. They just kept giving us names until we found someone who said yes, and we always found someone who said yes. That part of venture capital needs to be copied.
Looney, that's really
Thanks
interesting.
for that.
So, one of the metrics that the DFIs measure to identify whether they are being successful or not is the presumption that they're catalyzing capital, i.e. as a result of them coming into a fund, other investors are also coming in. And more than 5 years ago, the CDC, the DFI of the United Kingdom, one of their metrics became finding capital to come alongside their own, as opposed to more passively recording it. I know they've been trying to do some work on that front, but definitely the referrals, we see this on the angel side, right? If Raj brings me a deal, or if someone else I know brings me a deal, I'm more likely going to look at it, and there's a high chance of success because they've done some level of screening. And if it's a transaction that somebody I know has invested in, it significantly ups the chances that I'll invest in it.
Yeah, and
so the formalization of the referral network, I think, is absolutely critical.
And the difference here is just the culture, and this dates back to the 80s. The culture is I'm in for half. The culture isn't I'm in for some portion and other people will follow. It's just this idea that you always invest in pairs, and this is breaking down in California now because there's too much money. But just this idea that it's always pairs. It's always 2. It's not 3. It's not 5. It's not a syndicate of many. It's a syndicate of 2. Maybe it's a little SIF-like in that way, but it started because they didn't have enough money. It didn't start because they wanted to invest with each other. It started because back in the 80s, it was a tiny industry and they just didn't have enough money. So when they found a deal, they literally met over drinks and they would split up the deals amongst themselves. But it works really well. And it's like the most socially conscious part of all of venture capital in California and New York and Boston and elsewhere. And it's just not copied anywhere. It's like we lost that social aspect.
Well, it's happening right now here online these days on Clubhouse and through our investment network. So hopefully we can do more of these deals together through the contacts we meet here.
Hi, I just want to point out this year being the year of health, and last year, the health industry, biotech industry has attracted a lot of money. In Africa, it's a unique opportunity because you have increasing urbanization, industrialization, industrialized, food processing. So they are now accruing the wealthy nations' diseases as well. And it's a huge opportunity for digital health companies, for therapeutics, for service managed providers, because on the national scale in most of these countries, the health service is extremely bad. And the middle class and the ones who can afford it are resorting to private healthcare. And you will notice a place like Dubai, healthcare city is very popular with people from the African continent. And I think these sort of facilities can be created in Africa itself, together with digital and telehealth. So that's an area that investors in this panel should really look at.
On that note, Tan, we actually have we're hosting a pitch session from 2 health tech startups on February 18th. Same time, Thursday, same place. It won't be on Clubhouse. It'll be broadcast on Clubhouse, but it'll be mostly happening interactively on Zoom. So please feel free to follow me if you want to get updated on that, or again, go to untappedglobal.com for more information on that. And in fact, Geeta, who I believe has left now, is also going to be a angel investor on the panel for that pitch session.
Hi, I'm just going to introduce myself. I've been kind of lurking and have many thoughts on this, but I didn't want to jump in as I missed at least half of the initial first hour. So I'm a journalist. I wrote a book about entrepreneurship in Africa that came out in 2014, and so spent 3 years gathering business stories in that environment, if you can imagine, like 2010 era, based in Nairobi. And I'm married to someone who's worked for the CDC, which was mentioned as the UK's DFI, and also founded a company that does, I can't forget, I don't remember who it was that brought up the idea of helping businesses become investable and then investing with them. So they ran like a sell-side investment bank, basically, from Nairobi. So I've had some practical experience with this, and I guess, and also because I was raised in the US, live in the UK, and cover business generally, I have been more exposed to the kind of Western theory of venture capital. And I'm speaking now because of what Tan has said about health problems and non-communicable diseases growing in Africa and being an opportunity to make money. I think that's quite accurate. But I'm curious to hear this group's opinion about like venture capital and scale. One of the cynicism I have about venture capital in general is that it's so focused on growth and performance via growth and needing to get big at all costs, and a lot of money pumping into the task of getting really big. And in some cases, it tends to erode second and third order kind of social benefits. You can think about the rise of 2-day shipping as something that's probably pretty bad for the environment and for warehouse workers, but sort of built into the scale approach of a lot of consumer-facing businesses now. When it comes to Africa, however, scale seems to be one of the reasons why people are really attracted to the market, right? It's like, it's 1 billion people, it's like India, it's like China. And when it comes to things like social good, like health services or education services, or even private security, the more people you can reach, the better. And that's the kind of metrics that come from the development ecosystem, where you say, we've reached this many people, we've taught this many kids, we've done this many vaccines. So I guess this is both a comment and a little bit of a question. Like, I think scale is kind of corrosive in the West when it comes to VC-backed companies, because it leads to shortcuts on social welfare. But in Africa, I see like getting a good service to as many people as possible. You can do that faster in a private way. And maybe VC is therefore the right answer to that. So I welcome all perspectives on this kind of disconnect I have between the way I see VC done in the country I was born in and the way I see VC's potential in the African continent and other high growth markets.
Thanks for that, Dale. Any thoughts on that, folks in the audience?
Hi, it's Claude Church. My background is more commercial finance than VC financing, and then also trying to operate in Africa, various companies. I actually had to laugh a little bit about the comment about comparing Africa to China and India, and I'd be curious if other people feel the same way. Africa is just so much harder because it is more fragmented. In a way, you literally have to almost have a company in every country in order to operate and secure contracts. It's a really a massive challenge, and I think that for myself and the other people I'm involved with, once you're working in Africa, you more or less get attracted to it, and it becomes somewhat addictive that you want to be successful and keep plugging away at it, even though it is a tremendous amount of work. Yeah, anyway, I thought that was, I really like that comment about comparing Africa to China and India. But I was going to jump in before that to ask if some of the people involved here in the VC enterprise have tried to finance projects or companies using two vehicles. One is a special purpose vehicle for the purpose of isolating risk in a bankruptcy remote vehicle kind of aspect, and therefore everybody feels safe, and the money is going to be predictably used only for that one project or for that one venture. And the other question for some of the people on the panel was whether this aspect of using vendor money. So someone had mentioned, I think it was Tan had mentioned that China and India both investing heavily in Africa, which we have seen a lot of involvement in the telecommunication industry. So Airtel and Huawei have been very, very aggressive in Africa. And if they can find the right vehicle where they feel safe and protected, and that they're actually going to get paid for usually what is an investment in equipment, upfront investment in equipment and projects, then they have no problem jumping in and participating. I'm from Canada, so we have this unique position in the marketplace that Huawei is looking for friends, because we're really not well liked by Huawei right now. But the VCs used special purpose vehicles for creating these bankruptcy remote vehicles for projects. Or is that usually something that's reserved for something larger? I can tell you I've used it for a 1 million revenue project, 1 million annual revenue project. It doesn't always have to be a very, very large infrastructure project. And it was extremely successful. Everybody got paid out. It was great.
Thanks, Claude. Any thoughts on that from anyone in the audience panel?
Just
if I can
go ahead, Logan.
Sorry, if I can answer Deo's question, or the question that she posed. I think it's a function of what's being built, honestly. A lot of the innovation that's coming out of Africa is built out of a certain amount of necessity to increase efficiency and to build systems that are archaic, and to kind of change how things work and make them work a little bit more efficiently than how they've been working. And I think that's also a factor of like a first wave of innovation. Whereas in more developed markets, particularly in the US, where there's quite a bit of capital and it's fairly saturated. And I think someone earlier had a comment around musical chairs, which hit home, because it's true. A lot of companies that don't have a prayer in making any sort of profit end up going public, and investors end up getting exits even though maybe they shouldn't. So I think it's born out of like what is being innovated on in the continent. And then the other point I wanted to make is growth and scale, and that on the continent is going to be a lot more difficult and expensive, especially for that first wave of innovators, because We know how fragmented those markets are. So in regards to just generally VC as a model, there needs to be a spectrum of tools available, and there needs to be a spectrum of capital available with varying degrees of patience. But especially with these sort of first wave innovators that are expanding and moving into these other markets, there should be an expectation that this will be expensive, it'll be messy, it'll be difficult. And that risk is something that a lot of early stage investors need to realize and accept. And I think that's happening for the most part, but curious to hear what other people think.
Yeah, I think that's well put. I think you're either spectrum of capital and the exit or endpoint being more challenging, and the spectrum of patience as well. I think those points are very well made. I guess I'm thinking more about like, what is the good you are providing? And if the good you are providing in a Western market, and I've written about this, is something like, you know, a Japanese toilet that's got like, it's a robot basically, then the distributional impact of that is not a social problem. Where if you're talking about, you know, biomass toilets that are, you know, paid for with a small, you know, a small payment that are then going to be scaled across a large set of cities where there isn't good sewage, then the distributional impact is like much more important. And so the type of capital you want to deploy for each is obviously really different. I think when I talked about scale, I want to be more specific, like for the entrepreneur and for the people who are their customers, is going to be the best solution for the like social condition on the continent? Like, is it not good that someone should employ 75 people and those people should be bringing money home to their families and their business should be thriving? Is it truly important for them to conquer all of Francophone Africa? Or can they not just do that thing and do it well and thrive and pay their employees? And so that's where I feel like a VC might say, well, let's get into the rest of Francophone Africa, whereas a different kind of capital might say, I think this is fine. That's where I get stuck on VC for the region.
I think.
Can I speak to you? Can I speak from the entrepreneur's perspective to Dayo's point? So my name is Vivian. I run a company called Medzest, and we're the Amazon of pharmaceuticals for Africa. And we launched in Nigeria. And I made a specific bet. I had to make a specific bet when I started this company. I said, I'm not going to listen to what VCs are asking for. I'm going to focus on what customer needs. And that was a big gamble that I made because all of my competitors were focusing on what VC was looking for, like the metrics. And so this is the gamble that I made. So I don't know if you know Nigeria's pharmaceutical industry or Africa's issues with medication. Majority of them are fake and substandard. And, you know, it's run by this, you know, large, you know, this huge business. It's a huge billion-dollar business. But the players are not connected. There's no standardization. Obviously, there's a huge black and gray market, and fake and substandard medications seep through the cracks. And a homegrown solution to this is the open drug markets of Nigeria that fuel West Africa. So that is the situation that I found on ground. But when I would knock on the doors and speak to people one by one, what I realized is that if we could create a standard, if we could create a solution that standardizes their business operations, that we could actually, and we actually solve their real problem, which is that they don't want to go to the market. They don't want to have to spend hours or days waiting for their medications to come. Suppliers don't want to be in the market all day. They want a way to get their products across the country without having to put in so much work. And so if you could create a solution that actually, you know, addresses their pain points, it's going to be slower, right? It's just going to be much harder. But I believe that there's a massive potential for scale in that, because you now have a standardized system, you have a standardized processes, you have a standardized way to connect all of these various players in the market. And I believe that the scale opportunity is massive in that perspective, right? So it takes a little bit of patience, I think what someone said earlier. And it takes like really deeply understanding what the customer's real needs are. Like, what does it feel like to go in the open drug market and stay there all day looking for medications? You've got to feel that pain, and your company has to actually solve for that in a real way that matches what's on ground. And the other thing that I was really important to me was not coming into Nigeria. I'm a Nigerian, but I'm from the US. I didn't come into Nigeria saying everything in Nigeria is bad. I said, obviously, there are things that are working really well, and there are things that don't. So let's enhance and amplify the good things that are happening on the ground. So when I look at the open drug market and I think about the fact that, yeah, it's dirty, a ton of fake medications can come in here. I also think about the extremely sophisticated way that these suppliers connect with each other and price medications on almost an hourly basis, right? And so how do you enhance all these good practices that people are using to conduct businesses or to conduct business? So it was from that approach that I said, take the time, really build a powerful, a solution, but focus on customer service, and then you can achieve scale. And I think if more VCs actually understood the power of creating a real company that has like a really strong foundation that can last the test of time, versus hyper growth that's in a Nigerian context is typically fueled by someone knows someone and they gave them a contract. If you focus on like what's really happening on the street and build solutions from that, there's your impact, there's your scale, there's your massive billion-dollar unicorn. But it takes like a different mindset that I don't know if a lot of the investors that look at Africa actually understand. And I don't actually also think that a lot of the entrepreneurs in Africa understand customer service or, this kind of sustainable foundation.
Hello.
Can I
Just really quickly, Doto, and sorry about that. Vivian, thanks for that comment. And just to note for everybody, Vivian is presenting her company on the Nest on February 18th. So same time as today. So please join us, and I'll be hosting that show. So look forward to hearing your pitch on the 18th. Thanks,
Yeah, that's incredible, and I think the care you have taken in thinking through both your end user and your, I guess, enterprise client has made me think differently. That when you're talking about scale infrastructure like logistics or some software solutions, but obviously in many parts of the region, there's still a kind of like hand-to-hand combat last mile issue. Even the telcos know this, right? They still have to sell scratch cards for airtime. Maybe the distinction may be that scale for infrastructure enterprise type solutions is the fastest way to sort of create value for people, social value, and for investors. And then for consumer, I just feel that there is the denominator of people with cell phones has in some ways misled a lot of people into thinking the consumer tech opportunity is as big as it is in more developed markets. And that's where I'm just like suspicious. So maybe enterprise is a place where scale works, but.
Look, I remember growing up, my dad would get on the phone and call my grandma in the village, and it would take 3 days for her to get there, stand in line, and get on the phone. My grandma had a smartphone before she died, right? Like everybody in the village has a smartphone. Like they all have them, right? So the reality is there are solutions, but I think that people are not like putting themselves in the shoes of like the pain. In Nigeria, people pay 10x for pain. Think about like how much you would pay if you could get across the third mainland bridge, without and avoid all of that traffic in Lagos. How much would you pay for that? Right? Like people will pay for pain. So the innovation needs to go around like the real needs of the people in a way that fits with what they are used to, but also, you know, solves a problem so big that they will actually maybe adapt a new behavior. And then also on top of that, stop thinking that people here, the way things are working on the ground, that some of it, that it just doesn't work because it doesn't look fancy and shiny. There's a lot of business that is conducted on the streets every day, and there are good things that are working. So how do you enhance that? I'll just leave it there.
I'm
Can I
gonna
just
fully
say
agree with
something?
you. I'm gonna point out that my book, The Bright Continent, really talks through a lot of some of these examples of entrepreneurship for social good or social pain points. I guess I just think, and I work for a very large tech company. I worked for another really big large tech company before I did that, and I think that a lot of you could call it imperialism of some of these companies means that consumer tech is challenged in terms of homegrown, widespread, smartphone enabled services. And that's kind of what I meant when I was criticizing the opportunity for scale in that narrow example.
Thanks, Dio. Jotun, I think you have the comments. Before.
Yes, thanks. Thanks for putting this together. I just want to make a couple of comments around a few points, and I think they will all drive to the same conclusion that maybe we should try, or I want to encourage us to avoid zero-sum conclusion on this conversation that maybe VC versus or other type of investing, or some scale or defining scale in a narrow way, because there are the kind of businesses that, by the way, Vivian, you're doing a fantastic job, and I really, I'm a huge fan. The kind of business that Vivian was talking about that are probably creating impact or doing great job and but small scale. There are lots of them in Africa, and they tend towards a particular kind of investors. And there are companies like that that will be generating good money, creating impact, helping people to pay their rent and provide value to the entrepreneur, to those who support them. But not all those businesses are fit for VC. We have to understand that VC is a different model, and it's not fit for all businesses either, because VC is predicated on a few things. One, you're raising money from LPs who are time bound, who can put the money in other places, and they expect certain things from you. And you are investing in businesses that could scale really fast. Now, we can discuss and debate about what does scale mean in Africa, but VC is tending towards that kind of business that you want to exit within 10 years, or maybe in some cases, maybe 12 years, and build businesses that can really grow. And now you're also having some assumption around who is going to buy that kind of business, or whether they can exit in a public market. Now we can debate where we know that is not always the same. That's not always true in Africa, where you have sophisticated open markets or secondary markets. But we are getting there. We're still very early in Africa when it comes to venture. When I started coming to Nigeria 5 years ago, the kind of deals that we see happening were like in tens of thousands. If somebody raised $150,000, that's like huge. $1 million is like unicorn. Now we started seeing more venture coming into Nigeria, Kenya, and we're seeing more deals. And maybe it's quite early for us. I mean, it's a good question for us to have about, is VC the right model for Africa because of the market? And I think Dio really pointed it quite well, that the market might look huge on the surface, but if you go deeper, it's not that deep. Now, but we're still getting there, where people are coming in with money. Yeah, a lot of companies will fail, and that's part of venture story. But we need to start defining businesses that are venture backable. And there are some that are not venture backable, and they're going to build great businesses. And I think most businesses in the world are not venture backable, and most successful businesses in the world are not venture style businesses. But there are some businesses that can grow really fast, that can use technology, innovation to grow really fast and return value for the investors and for the entrepreneurs. And we start seeing some of them. And I hope that we will start experimenting. Now, the way venture will be done in Africa might be different. The way exit will be done in Africa might be different in the long run. The way LP should be writing the LPAs and expecting from fund managers might be different. But we're still early. we're still early and we still need a lot of venture start business, and some of them will fail, but it's still early for us to maybe reaching the conclusion that is maybe narrow in this with this question.
There's one
Thank you,
point on the
Dr.
exits just wanted to make, and that's even in the US, 75% of the successful exits are for less than $250 million. 50% are for less than $150 million. So I know all the headlines are about the IPOs, but that's not where the industry is. That's not where most of the activity is. And if you can get trade sales for $100 to $200 million, that's a success. That's a great deal, depending on how much you invested. And the other thing is, there is one absolutely brilliant listing market for African stocks, and that is London.
Good point. Thank you, Stefan. We'll have to end this here. I need to get running, and again, I can't keep the room open anymore. But thank you, everybody, for being on this, and I really do hope to see you the next week. And please, any suggestions on topics for following weeks, we definitely welcome them. So please go to our LinkedIn page and send us a message if you can.
Thanks, Jim. What's the topic next week?
The topic next week has not yet been decided. Do you have any suggestions?
I'm new here, so I'll let you pick the next one.
Okay.
Turning
Well,
Africa's informal markets formal.
Oh,
using
I like
technology.
I
Using
like it.
technology.
That's-
And can I speak?
That's a
I'll
great
talk about
topic.
that.
Yes, please do. And that's Luan, right? Who
Oh
just
no,
spoke.
sorry. I think that was Vivian who spoke, but I just thought that's a
Vivian,
great
yes.
idea. I support
Absolutely,
that.
Vivian. Okay, good. No, Vivian. I mean, I think I know you know this already, but that's essentially the core business model behind Untapped, right? How do we help the businesses that are going from informal to formal, the ones that are using the digital economy to do that? How do we get them financing? How do we do that at scale? How do we do that with good returns for investors and easy access for entrepreneurs? So that's really what Smart Asset Financing is about. And apart from the pitch sessions and these kind of conversations, what we really care about is how do we transform the lending market in Africa so that more people can access capital so they can grow.
But before everybody goes, I just want to point out, if you Google Partech Africa 2020 or 2019, you'll get an annual report of the African VC landscape.
Yes, indeed. It's a good report. Thank you very much for that, Sam. All right, on that note, thanks again, everybody. For more, for more information, please find us at untapped-global.com, and you can sign up to be informed of future sessions. Thank you.
Thank you.
Thank you.
Thank you.
Thank you all.
Take care, everyone. Bye.
Thank you.